so what made me take a deep look at the overall picture from the outside was because I think today usually, like I said, at the end of every week, I look at the overall on the weekly chart. I look at the overall outlook on the past week, where it came from, where it went, and where it could be going. And so when I look back at it, I started to see this double top here. And once I saw this double top here, it made, for whatever reason, it made me look at this low right here. From, like, I don't know why. I thought about how the market got to where it's at, and I'm like, damn, this was the last major low the market put in. This was back in 2022. In January, when this market started to sell off in January at the beginning of 2022, fast forward to 2025, the market is now showing a similar, I guess, price pattern that it was showing back in 2022. And when I'm looking at this move here, and how could I confirm that this move could be like this whole move right here? How could I confirm that this entire move right here in the stock market over the last, I guess, 2 years or so, how is this, could this move possibly be over to create some type of like pullback to these areas right here? And so let me go, I can explain these areas too, because I forgot, I ain't even tell you what these were. So these three levels right here, these are those Fibonacci retracement levels that I marked out for ultimate points where the market should be going if it does play out the way it's supposed to play out. But I'm gonna put these back on here, but I'm gonna show you how I did the Fibonacci retracement though. So what I did was I saw this ultimate low right here in 2020. So this was 2020 low. After 2020 put in this low, I drew this low until this ultimate high here back in 2021. This was the end of 2021 going into 2022 when the market started to sell off. But the thing is, when you're using like a Fibonacci retracement, you don't really know when the pullback is actually happening until the actual pullback is happening. So I wouldn't have seen this and just put this on here and assume that this is gonna happen. I would only have known to do this after this level here. Hopefully this don't look crazy when I draw this on here. I would have known to do this after this level right here broke. So basically, once the market started to do this and put this high in right here, this is pretty much, you can kind of assume that this is a lower high, which is what you got here when it rejected the trend line once and came back here, tested it and broke above it right here. But once the market started to drop from here and I started to connect highs, once I get to a point where I'm able to like connect highs and I can see like the formation of a possible trend, I usually just mark out the trend, and if it maintains, it maintains. But I always do this. I don't wait. Usually they say you got three touches is a trend.
Right.
Because I see 2 pivots, it's a trend to me until it's not. You know what I'm saying? So when this happened in the market back in 2022, and I start to see this, then I'm like, all right, bet I won't say assume, but I can anticipate that after this low getting put in, I can assume that it didn't get above this high right here after rejecting at this high again. So I can assume that if this is a double top after already a high that was put here, this could be a lower high confirmation because it rejected twice, which makes it a stronger low. So for me, once I mark this out, I'll just put the Fibonacci retracement after this. Now, if it would have pushed up, I would have just taken it off. But for me, it's like I do it for dressing up the chart. So I look at it as like, I'm gonna just put it on and I'm gonna watch to see how the market reacts to those areas as they come about. And so once I put this on here, I knew that before the end of 2022 came, the market was gonna get to either 3 spots. Really either 4, but this is like a yellow light. And if you think about driving a car, is it yellow light or orange light? I'm colorblind.
Yellow.
I would say yellow. So you think about driving, you got the green light, the yellow light, and the red light. So when I'm looking at Fibonacci retracements, you notice I got these 3 right here, green, and I got this, well, it's supposed to be yellow, whatever, but I have it orange, right? And so because I have it orange, the reason why I have it orange is sometimes when you use a Fibonacci retracement, this 27.2% level can get buys off of it as well, which is why you saw when the market pulled back to this point here, it jumped actually nicely before it actually came back down to retest this point to push back up again. But if you look at these exact levels, even when it came down to the 38.2%, it bounced a little bit. And even though it retraced this right above this 38.2 and came back up, the ultimate point that it tested was the 50%. Now, mind you, this 50% lined up by itself, and the only thing I did was mark the low and the ultimate high of that whole move. That's the only thing I did. The market itself searched out this point right here. And you could say that's coincidence, or you could say, well, if you're telling everybody that ultimate buyers are going to come in at a golden zone on a Fibonacci on Fibonacci levels, and that golden zone is the 50%, between the 50% and the 61.8% levels. Let me make this look like it means something. So this would have been a golden zone for me right here. Anywhere between this, even if you look right here where the market consolidated here, let you know that anytime you see, even if you see this on smaller charts, what do they call that? Demand. So you know for a fact that looking at this Fibonacci retracement and looking at how the market was consolidating heavy at this point, at some point, that I guess that could be even more confirmation that this could be an area where if the market continued to push down in here, if it's breaking these levels right here, and this is just you using if-then statements. Because let's say you're using Fibonacci levels and you're trying to be like, oh, I'm buying it to 50%, and it never gets to the 50%. The market could have pushed crazy from the 38.2%. But that's why you use what ifs and if-then statements, almost as if you was a coder. And you think about code, you think about AI. AI or code doesn't have an output unless the input occurs, because there must be an input to get an output. So the output would be your trade. The input would be the confirmation that this thing actually happened. But you wouldn't assume that we're gonna automatically buy it to 50%, but you would sit back and watch. Basically, the market could have pushed up from here and kept going. But as you're sitting back and watching, you still have that if-then statement of, well, if it gets above this, I know that this entire drop is over with because it got above this trend line. What did it do? It printed combos and it rejected right off of this trend line, giving you more confirmation that even though it's pushing back up, this might still just be a pullback and retracement from the upside to the downside. Because remember I said you could use Fibonacci retracements in all directions. So this right here could have been a Fibonacci retracement here, which you see where it went back to the 50% area right here. And this is me doing a sidebar just to show you how crazy this shit works. But you see this, it went back to the 50% area right here from this high to low. And the way you know how to use the Fibonacci retracement is the high to low has to go with the trend. So if this trend is already down, this high to low needs to be pointed to the downward direction. So your Fibonacci retracement needs to be, the 0 point is the point where it stops at, where it starts to retrace backwards. So going back to, basically it retraced 50% of the move that it already made. So if the last move from the downtrend was already down and the last move pushed it here, you're asking yourself, okay, well, if the price pushes back up, as long as it doesn't form a new high and create a new trend to the upside, that means that if it rejects off of here and it hits this 50% zone on this retracement, on Fibonacci retracement in this golden zone, then the odds of it pushing down from here and continuing that trend are high. But remember, the market is a multitude of trends within trends within trends within trends. So as long as you're with trend, whether that's the long-term trend or the short-term trend, as long as you know what direction you're in, you're not going to swing for the long-term to the downside. You might swing into here to the downside, but you ain't going no further than that. If your bias is still the retracement is coming here. You see what I'm saying?
Right.
So for me, at that time in the market, I'm watching and it pushes down to the 50% zone. Even for me, when I saw it finally get here, my mindset was still if then, because yeah, I'll get in here, but it has to respect this trend line. Once I realized that it broke this trend line and you get this higher, you get these two, I guess double bottom higher highs right here, you can somewhat anticipate that the market is ready to start pushing up, especially once you get this breakout of this trend and retest right at the outside of the trend line. You see what I'm saying? So those were good confirmation points. Fast forward to 2025, because I feel like I was speaking too much on it. Fast forward to 2025. Remember I said you can turn your Fibonacci retracement into a Fibonacci extension. And so I extended this Fibonacci retracement to the upside, because the Fibonacci extension tells us once that move has retraced completely, once our retracement is complete, the next move is now I won't say it's assumed or guessed or whatever, but I guess the Fibonacci retracement paints a possible outcome in terms of how far the price should go before it slows down and starts to retrace again, as it did here when it pushed and started to retrace again. So the question that you ask yourself is, when is the next time this is, no, I ain't gonna do that. I'll put this on it. When is the next time this is going to happen, right? That's what you want to ask yourself. So once this Fibonacci retracement becomes extended, now we ask ourselves, after it returns back to the 100% mark, how far can it go before it runs out of gas to start moving back down again? That's when you get into the Fibonacci extension going into the red zones, which is 121.7, 121.2, 150, and 161.8. So you look at those prices, once you start getting in here as a move to the upside, you know that you're looking for the market. It could have came here and just rejected back down, but you're watching and you're looking for the market to continue to push. If the market continues to push beyond this point here, then how far could it go? So at the beginning of January 2024, that was one of my biggest questions. If the market does push above the 2021 high after it came here and pushed back down, is the market going to get back here and sell off? Or is it going to push? If it does continue beyond this point, how far will it go? Will it until it stops pushing again? The Fibonacci extension says that it should die off between 607 and 640. Now, mind you, these levels were picked off once this Fibonacci retracement was completed here, and the extension was put on right after this completion was happening. So if somebody was actually like nasty with it, they would have basically played these Fibonacci extension levels all the way until here, which is where you have this no-go zone that, and I don't want to see nobody using my no-go zone. That's my shit. So you got this no-go zone here where, for me, I expect price to not even go beyond this point. I expect price to start dying at this point. Now, the cool part about what I've been able to see up until this point, and let me go ahead and mark this out because I told you I was going to mark these out for you. First, let me remove this Fibonacci extension because we don't need it no more, because I already have the ultimate level marked out up here. So I don't need the Fibonacci extension anymore. I already have the levels right here in this no-go zone. It can't go, it shouldn't go beyond this point. Now, the next question is, now that it is here at the rejection point, what other confluence factors can I find to confirm that? For one, if I'm looking back at, now history usually repeats itself, but you know, it's not going to be picture perfect. For one, when I'm looking at the level that we're at now, I see that it has this double top. The market has been struggling at this point since October, or if you want to push it back, yeah, since October of 2024, the market has been pretty much sideways at this area here. Meaning that if the market is sideways for this long, the market ain't been sideways for this long ever since it's been moving up. It either went up or it went down. The last time the market was sideways for this long was here before it actually made a bigger move. And even though it retraced here, it wasn't sideways. It was another direction. But the fact that it's sideways for this long means that buyers and sellers are indecisive about where the hell the market should be going. Basically, if it's going to push beyond this point, we don't know. We don't even know if we want to keep buying from this beyond this point. Sellers are like, shit, I want to sell, but I'm not finna sell unless it gets below a certain point. So sellers aren't stupid either. So you got a bunch of people pretty much playing this zone right here. You got a bunch of people pretty much just playing this zone right here until it is no more. So when I look back at 2022, and I see that weekly chart, let me put these moving averages on here too, because I want you to see how I compare it using the moving averages as well. So when I'm looking at 2021, 2022, we had this week right here that sold off. This is a big drop in the market right here. January 2022, the 18th. After this happened right here, the market, even though it wanted to sell, it could not sell just instantly. It had to basically go through a bargaining phase where buyers and sellers were at war with deciding I guess the direction, even though the direction wanted to go down. But in order for the market to go down, it needs liquidity to do that, which is why you see a lot of trickery right here, because we can't just send it down, because everybody knows that if everybody's playing the same way, breaking retest and supporting resistance and all that shit, if everybody's doing the same thing, then we can't do the same thing. So when you think about the market, you got to think about the game that it has to play to go where it wants to go. So even if it wants to go low, even where it's at now, if it wants to go low, it's not going to just immediately go there. But if you do have capitulation, meaning there's an immediate drop with no trend, no nothing, it just does this straight down. It capitulated once, or if you want to say twice, but it's not just going to, it's not something normal that just happens all the time. And even when it happens, you really can't time the shit, because you really don't be ready for it to do that. But comparing this right here, this double top right here, and this indecisiveness at the beginning of 2022, and then looking at the indecisiveness at the beginning of 2025, and you see where this last week pushed down, where did it break below? This was the last time the price on the weekly chart broke and held strongly, closed below the 20 moving average. This price ain't closed. Even when it got below here, it pushed up every time. It regained that level. So here was the first time it closed below the 20 moving average, right here, which is March the 3rd. Very close to the end of February. So we could still, well, damn, no, it's not, because March the 3rd was where? Here. This was March the 3rd here. So the move had already happened from here. So basically, the market is moving way slower than it did here. That's why I say it's not going to be picture perfect. But you still want to anticipate the possibility of it being time to basically have that good drop or repeat or retracement in the market, just due to those fib levels and that Fibonacci extension area. If it does push above here, then hey, boy, we bullish as hell. That's all I can say. But in terms of me and how I'm playing the market, I don't give a fuck if it does push above here. I'm looking for it to do, if it pushes above here, bro, and you hear here first, I'm looking for it to do something like this. Let's say it does. I'm looking for it to do one of these and then do one of these. I'm looking for the ultimate fake out.
Right.
That's what I'm looking for. I'm looking right now after this, like me being me who I am now as a patient trader, I'm still not assuming that our economy not strong enough to send us to the moon.
Right, exactly.
It's not strong enough to send us to the moon. So there's no way in the hell that I'm going to assume that I'm not buying above here. I don't give a damn. You're going to have to push so high that I know it's just a break and retest for me to buy after that. Other than that, bro, the market, I don't care what nobody says. If it happens, I'll trade with the trend. But other than that, no. Anything slightly above this point here, if it ain't a nice move, and then a nice retracement beyond that, where I can see levels being formed, new levels being formed, because this is no man land. Until I see new levels and all that being formed, this is where the patience come in of like the great traders. This is where you're sitting back and you're just watching and playing your if-then statements. But for me right now, what I'm seeing as in terms of like the overall next long-term outlook, I'm seeing this no goes on here, which is at the Fibonacci extension, basically give us a hint that the market is out of steam and we're ready to at least pull back. Now, fast forward to what I was really trying to show you is how far could we drop down if we do drop down. This is where you go back to using that Fibonacci retracement again. So I'll put that fib on this last ultimate low and this last ultimate high right here. This is the last ultimate high. You remember I said, if I would have did it here, and what I would have did if it didn't work out? Meaning I'm putting my Fibonacci extension here only because, I'm putting my Fibonacci retracement here only because it's hitting at the ultimate extension point. The Fibonacci extension says that it runs out of gas at this point. So if the Fibonacci extension is wrong, then it's wrong. But I'm going with what I know. So if I know that the market is supposed to run out of gas at this area, basically imagine if I was playing the market here and we had this pushback. I still would not have done nothing because the Fibonacci extension kill zones were up here. So I still would have anticipated for it to get up here some more. before I thought to actually start selling the market, which is what I did. And also, when you're looking at those moving averages on a higher time frame, you're asking yourself, which moving averages are strongest right now? And it's been the 20 until it's not. And the last time the 20 held strong was this move here until 2022. So this move here held strong above the 20 until 2022. This week right here. Now you fast forward to 2025, market held strong. We finally closed below the 20 moving average. Strongly. So at this point, that's one part of the puzzle that I have complete. But like I say, I'm looking at all factors. I'm looking at any type of other confluence factors that I can add to, I guess, my bias of selling the market. So even looking at how when it closed below here, it was still not below this low here, and it was still not strongly closing below the 50 moving average, which is what you can see here is the fact that it's actually holding the 50 moving average. It's buying off this 50 moving average while closing below the 20 moving average. So you can assume right now, if the market is going to do anything at this point, it's going to buy the low of this this zone here, because this is a range. So at a range, the highs and lows are the strongest points, which is here and here. So right now, you just want to buy the highs and lows of this range right here. And so if I'm looking at this, I'm thinking, okay, this moving average here and it's between this moving average here, I'm assuming price is going to trade between 588.74 and 565, 566, at least for another week.
Right.
At least. And the only way it doesn't happen is price has to literally break the high of last candle's high, or has to break the low of last candle's low for me to be wrong. But the odds are in my favor because it's a big ass selling candle. And for it to break the low of this candle, that means that it has to also break the 50 moving average. And it also has to break the low of this range, which is a strong demand area. So even if it does break below here, it should be a nice little move, right? Mm-hmm. That's my assumption. Another confluence factor is looking at if there were any divergences in the market when the market was pushing up. So you had this divergence here, high, lower high, which is a downtrend, but then right at this high was a low here, and then you had a higher high here. So even though the market was trending upward, the RSI was trending downward, meaning that was opposite move, which is a divergence, and it was a divergence to the downside. And we're following the RSI, not the price movement, to confirm the divergence. So meaning the RSI has to be the one making the opposite move to say what the next move is going to be. So if the market is trending up, the divergence has to be to the downside to let us know that there's a negative divergence to the downside. So here's your bearish divergence here. You got this high here, and then lower highs beyond that. But then right at this same high, you have this high here, and the market put higher highs in going up to here. So as the market is pushing up, the RSI is pushing down, meaning it's foreshadowing a bearish movement, calling it a bearish divergence. So for me, these are key things that I'm looking at to watch to see if the market is gonna repeat what happened back in 2022. Now, obviously, you can't assume that history is gonna repeat itself 100% accurate to the T, but if we do get a move down, these are the three areas I was looking at. Remember I said when you get a Fibonacci retracement, you got three areas that are important. For one, we have our golden zone, which we can go ahead and mark that out. Our golden zone would be somewhere between the 50% and the 61.8%. So we can go ahead and just mark that golden zone out. Now we got our golden zone marked out. What are the areas of interest that we will be looking at? Or possibilities, 61.8, 50%, which is the one everybody wants to get in at, this was the 50% here. The last 50% we had was here. The next 50% we have, if it gets there, is here. Yeah, somewhere in here. And the reason why I put it here is because this trend line here is literally sitting right here. So if the market does break these two trends, then obviously you can assume that the next major trend that it should hit is either here and here, one of these two. But we're talking about if then statements. That's if this starts to happen, right? But we'll just mark this area out here as the next 50% point. We'll just have this here so it can be a point of interest. And I'm gonna leave it on this chart, like, and we'll just watch and see how it unfolds. But yeah, so you got the 50% and then you got the 38.2%. Now, honorable mention, once again, is the 27.2, because it can hit this 27.2 and take the fuck off. The reason why I say that is because the last time the market made a consolidative move, even though it wasn't a long consolidative move, the last time the market made a move and adjusted in that area was between these candles here. Meaning that if price did push back down here, the next 2 points of interest where liquidity would be sitting at would be below this low and this low. Meaning that it could get to 27.2 and then start buying again from here. It could also get to 38.2 and start buying again from here. So you want the ultimate buy area for the market to get back to a ultimate super long bullish point, like this long-term bullish point from 2022 September all the way to now, which is like a 2-year run. You want that to happen after it gets to this point. Because the deeper the retracement, the stronger the move is going to be. So if you get like a slight retracement, that means that the next move might not be as strong. The reason why I say that is I think, hopefully I'm not wrong, but I could be wrong. I don't mind being wrong. Let's just give an example of that. So let's say that the market, let me erase this right here. Let's say that the market from this last retracement here, let's say that the market pushed into the 20%. And let's say that it bought from there at the 20%. If it bought at the 20%, when I do my Fibonacci extension, the Fibonacci wouldn't go yeah. So you see how it pushed right back into here? D.
I'm looking, trying to find your mouse.
Oh, snap. Okay, hold on, let me see.
All right, so that's at the 78.
You said what now?
All right, so there's a 78.
For which one?
And where your mouse at? All right, now your mouse at 61.
Oh, okay, you can see it. Okay. All right, so initially I said the retracement happened here. So we would assume that the market would go from here to here instead. Damn, now I can't get my retracement to work.
It retraced to the 50% and then
Put the wrong one up. Okay, Fibonacci extension here to here. All right, got it. All right, so what I was saying was, when the market makes a retracement, the deeper the retracement, the stronger. It's like a if you think about a bow and arrow. If you think about a bow and arrow, in order to shoot a bow and arrow further, you have to pull it back further, right? So if you
Right.
think about a pullback in the market or a retracement in the market, the deeper that retracement, the stronger the move would be. The shorter the retracement means that that pullback wasn't the ultimate pullback. That's basically it's an indicator to that previous pullback move wasn't really the next pullback move. It's almost like if I came here and I said that this was the next ultimate move right here in the market. This was the next ultimate pullback in the market. But even right here, when it pulled back here, the area that it touched, no, it actually touched close to the 50%, but it kind of caught at the 38.2%, at the 38.2. But I'm gonna go ahead and say that it did touch the 50% because this is too close. So I can't even use this example because this is too close to the 50%. So this was another accurate judgment for the Fibonacci retracement, to be honest with you. Even when it got here to this 61% point after I flipped it to an extension, it rejected at this point right here. So I can't even use that as an example. But so I'll just go ahead and just keep it, which is what I'm saying, that if the market does pull back below this point, then it could still buy off of this area here. It could still buy off of this 38.2 area here. But ultimately, you want to buy at this 50%, 60% golden zone area. Most times when it does try to get to a golden zone, it's not often that it goes deep into the golden zone. But you notice that every time I use the Fibonacci retracement, it bought either at the 50% or right above the 50%, somewhere between that 38 and 50% retracement range. But back to what I'm saying, this is a key area that you want to watch out for. So let's say we're playing the pullback, right? Let's say we're playing something like this, like let's say me and your ultimate outlook would be, it breaks this trend, it catches this 28% area here, it pushes up. We assume that it's going to push up, create a lower high. We're just going to assume that it's going to do the exact same thing that it did in 2022. It consolidates a little bit, creates a lower high, it breaks down, continuing the trend downward, basically getting back to this 50% range right here, right?
All right.
We'll say that if this does happen, and we do get that 50% retracement move, and it does occur at the perfect golden zone area. And all this is hypothetical, by the way. This is all hypothetical. This would be the same occurrence as this 2022 market retracement. So we'll say from now until the October 2025, which looks like it was about the same time. Damn. It looks like it was about the same time in 2022. So even the little hypothetical that I just did, it ended up at the end of the year in October, where we got that final push down into that Fibonacci golden zone before it continued pushing up right off of this trend line. All this is super hypothetical, but it's good to have those if-then statements, because if certain things start to occur, then you know how to interact with the market when it happens. And if you get stopped out, if your move gets canceled out, then you know to just get out. You get what I'm saying? Like, it's giving you a good outlook. Like, we have enough factors stacked up right now for us to have a clear overall outlook on the market. Like, we have the factors stacked up for us. So for us, our bias is okay. It's not 100% sure, but we have enough data to say that the possibility is there for this market to somehow at some point break down below this range and finally make this next retracement, this next deep retracement in the market, so that there's another buying opportunity. So for me, this is what I'm seeing in the market right now. This is what I'm looking at. I'm looking at buying over the next week or two. I'm looking at buying going into next week. The only way I don't buy going into next week is if we get a strong selling candle below here and it closes below this point right here. And even then, if that happens, I'm still not gonna assume that it's just gonna keep selling, because a close below here could turn into a what? A move back up, and it never pushed down. After it closed below here and it never pushed down, it gapped down. But as soon as it gapped down into this demand area here, what did it do? It bought right back up, and it never stopped from that point on.
Right.
So you still don't want to assume anything. You want confirmation, which is why you play the time frames according to each other. So that means that if I'm looking at this weekly time frame, that means that I want the daily to be giving me some type of confirmation as well. And even if I'm using Jeanius, right? So if I pull up Jeanius right now, so not only is Jeanius drawing these trend lines for me, but it's also letting me know here that it's at a trend line. So let me move all this stuff out the way. Well, do I gotta move all the way? Let me just extend it. Okay, just so you can see Jeanius real quick. Jeanius is telling me that outside of it sitting in a supply area that's been tested 7 times, it's sitting in a demand area that's 5 times as strong as the supply area. It's being tested 14 times. This is the weekly chart, by the way. The untested, is that an untested low that's been tested twice? Usually an untested low is the beginning of a liquidity sweep. You can take and do with that as you will. An untested low is an area where liquidity is sitting at. So it swept this untested low. It has a strength of 2, and it's the sweep streak with 3. The volume at which it swept was 254 million, 0.621. And what other things does it have? It's telling me that we have a supply break and retest, meaning that it broke a supply area and it's retesting that supply area. That means that it broke above a place and it's retesting at the top of it. And not only is it retesting that, it's at an uptrend that's been tested twice. So you can kind of look back and see that it's at this uptrend. And this uptrend was, I would probably say this uptrend was tested 3 times. Yeah, I would probably say the uptrend was tested 3 times, more than twice, unless you don't count tests until the actual trend forms, which is after the 3rd touch. So if it's going by rules, then yeah, it's been tested twice. Fair value gap is also sitting in the fair value gap. This shit right here is key. Between the fair value gap and the liquidity sweep and the untested low, all these, we'll just say all of them. But the fair value gap is key as well, because the fair value gap is searching areas where the market has fair value in it. I mean, it's clearly what it is. Like, that's areas where you would say orders were not filled at some point, and it gapped away from those orders, and now it's back into this area to collect the rest of those orders. This fair value gap has been filled. It hasn't even filled 100% of this. It hasn't even filled 50% of this fair value gap. Jeanius is telling me that it's only filled 43% of this fair value gap. Now, does the price have to fill 100% of a fair value gap to make a move? No, it doesn't. It only has to fill a partial of it. As long as the orders at which the fair value gap is filled, it has enough liquidity, then it'll move from there. So let's say a fair value gap, let's say price fills 25% of a fair value gap, not even 100% of it. Let's say price fills 25% of the fair value gap. Let's say right here. So let's say this is a fair value gap here, right? After this fair value gap, price touched at this point here. Let's see how much was swept in this fair. Well, I guess let's see how much was picked up in this fair value gap. 19%. So this wasn't even 25%. But let's just say that at this point in the fair value gap, let's say that these were the highest orders. So even though it was a bunch of orders in here, let's say these orders held a lot of weight. You get what I'm saying?
Yeah.
So it was still able to. I feel like you learning something today, bro. I feel like you sharpening your tools, brother.
So basically, you saying if Let's say if a nigga got 10 contracts in NQ.
Mm-hmm.
So he gotta come down and get some of them contracts.
I don't want to use contracts because I'm not as well versed in futures just yet. Even though I trade them, I can't tell you the underlying information on the futures contracts. So let's just do shares. Let's just do shares themselves, and let's use like a time and sales chart for that. So let's say this SPY ETF right here. Let's say that one share at that point in time, I don't know what the hell we were for that example. Let's say one share for that point in time. What was it here? No, it wasn't. What the hell? Oh, right here. Let's say at some point in time. Ooh, this is gonna be a good ass example. And the only reason I say it's gonna be a good example because look what happened when price got back into it. It came and closed out the rest of those orders.
Right.
Okay, all right, that's cool. But it did make a nice move from here. So we'll just say this move was strong enough. Let's say that at some point, let's say me, you, and Justin were buyers in this area. And you was a buyer here. I was a buyer here. And Justin was a buyer here. Right? But let's say out of the orders that we put in per share, these shares here are worth more than these shares here. So let's say that these shares down here, even though they're worth less, you only bought 1,000 shares. Well, is this me in the middle? We'll assume it. I bought 2,000 shares. Justin bought 4,000 shares. Who spent the most money?
I did.
What?
You said my shares are worth more.
No. Lower means lower price, right?
Okay, all right.
The lower we are, the lower the price, right? So if the shares are cheaper here, that means that in this gap right here, us three are buying shares in this gap. But within this gap, you bought shares at the lowest price, which was between these 2 points right here, 512 and 514. You bought 1,000 shares, right? I bought 2,000 shares. So I bought 1,000 shares. Let's say we all bought 1,000 shares. I bought 1,000 shares, but I bought 1,000 shares at 514, 517. Justin bought 1,000 shares at 517, 519. Who spent the most money?
He did.
He did, because his shares cost more, right? So you can assume that the highest shares prices, the most value was up here. So when it tapped into here, it was enough liquidity to push the market up. For whatever reason, the market felt the need to go back down and fill the rest of those orders because maybe it needed more liquidity, what it did. It needed more liquidity because as soon as it dipped back below, closed out me and your orders, what it do? It swept below this point here. Even though it is swept below a low, it swept below this low. And matter of fact, we can actually look at how much liquidity it swept by looking at Jeanius. It swept 218.714 million volume of liquidity here. And that's a lot just for sweeping this one low right here. Because this was the low that had the liquidity sitting in it, which is why you had this strong wick on this candle. And clearly it had all the liquidity sitting here because it collected the highest point of the fair value gap, which is where a good bit of the valuable money was sitting at, because this was, I guess, where the highest order was worth within this area. And then market came back down, swept below, closed out the rest of that fair value gap. And what did it do? Look at the percentage of that fair value gap. Even though I think it should be 100%, it says that it filled 88.6%. And maybe it did only fill 88.6% because just because price moved through here, that doesn't mean price actually filled this point. Price could have gapped and then gapped back up again. Possibly. Let me see. No, it did. It gapped down and then pushed back up. But there still could be gaps somewhere within here as well. You see what I'm saying? So even though price pushed into here and immediately started pushing back up, what if the move happened so quickly that it pushed into here and pushed back up that it left orders behind again? which is what you can assume. You can kind of assume that it left orders behind again, because technically that candle never was filled. This candle here was never filled in the first place. And usually every candle overlaps another candle. So usually every candle gets filled. Same way how this long candle happened, price came back down into this long candle, swept some more liquidity by filling that gap. If we go back to this candle here, 74% of this fair value gap was filled. It had enough liquidity for it to move up again. So imagine you playing fair value gaps on a higher time frame. That could be another strategy that you put in your tool set, is to watch fair value gaps being filled at a higher time frame. You know that it could be a good move. So right now where we at, you have a lot of purple. Usually if you're normal traders use red and green. I don't. So for my purple side, which is my long or my buy side, I have a lot of things popping up on this Jeanius chart. Meaning that the strength of this one candle right here, even though it's a selling candle, the strength of this selling candle has a buy side bias on it, meaning that the odds are pretty much still in the favor to continue in this range and put this buy in. Especially if you get something like this, where this candle pushes back up and closes above this line here, and this candle pushes back up and closes above here, you can assume that the revival of this trend is still intact and we still want to go higher, which is probably what's in the hypothetical for it to kind of go higher and put in that lower high. But maybe that lower high could also be the beginning of a head and shoulders, which is also another reversal pattern. A range is a reversal pattern, a head and shoulders is a reversal pattern, and guess what? A double top is the beginning of a reversal pattern. So there's so many things that can be played from this area, but ultimately, if we're talking about going into the next week or so, talking about what we want to do next until the overall outlook that we want to happen happens, for now, the market is still up. It's still bullish, looking at all of the parameters lighting up in Jeanius, and we're sitting at a demand area. So at the end of the day, price is telling us we either going up or we finna trade sideways until we go up or down. And this goes back to looking at those moving averages. This goes back to that. So we could play in this area here, being that it closed below this 20. But let's say price next week, price gets bullish as hell and it pushes up. And not only does it close above this movement, above this trend line, but it closes above the move average as well. I'm bullish as hell from there. I might even expect us to keep pushing up. But once again, we don't know. So we can only play the if-then statements. We can only continue to work week to week, build cases around if-then statements, and make sure that we're just knowledgeable of what we're looking at when we see it, so we know what the possible outcome would be. I guess, does all that kind of help with the outlook for what we're looking at in general, right? Just short-term and long-term?
Right.
But in terms of what I said with the market, you had one more thing to add about, you talked about some fundamental stuff. I don't want to call it fundamental. What would you call it? Like news type stuff? That could be fundamental. Not fundamental. I got to get this right.
Well, I look at the economy. So it's like the economy, like, this confirms what the economy going through, especially because it's trading sideways. Mm-hmm. So like I said, we at a high deficit. And you kind of can see that in the groceries.
Oh, sentiment. Sorry to cut you off, but sentimental. Go ahead.
But yeah, we are at a high deficit, and I doubt if we just keep pushing up and up and up and up. Like, I doubt that, because then I mean, the more we push up, the more money they gotta print.
Got you.
So, and that's not like, you know what I'm saying. We are making an observation what we see with the chart, but also what we know about how the economy works when it comes to money and businesses, especially we looking at the SPY and businesses. So, and I think what's kind of making this range is all these cuts they're doing. You see what I'm saying? Like, um, if he would have had the same workforce and all this other stuff going on with the tariffs, it would have been we would have had a shit show. But because there's not a lot of, he's cutting off a lot of fat when it comes to jobs and aid and grants. All that surplus is being created.
Mm.
So, not saying I agree with it or disagree with it. I'm just making an observation, you know, because I don't know who will hear to this and they probably get offended thinking you're a Trump supporter. So, I'm saying that surplus has got us in a range because we have some breathing room,
When you say surplus, um,
meaning
like
the
the
tax
like we got more money than we need. I mean, I don't know, bro. I'm gonna let you explain.
surplus, meaning the tax dollars that come into America, I mean, that comes to the government from taxpayers, that usually would go to the Department of Defense or the U.S. aid or these government jobs. Now they're just sitting in an account.
Got you. Okay.
So it's kind of like a savings account that's just stacking and stacking and stacking because we're no longer spending money on BS anymore. And
Mm.
then now you got all these other surplus things coming in, like like I say, the $5 million gold card, or the Taiwan got that $100 billion um, superconductor chip thing. So it's like they're trying to create a surplus, dog, to where they trying to balance their sheet out. Basically basically that's what you're seeing right now. They're trying to balance their sheet. So it's like we're not trying to get our deficit all the way to zero. We're just trying to equal out this deficit and the surplus at the same time.
Got you.
But at the same time, it's like we're on a stopgap. We're gonna do another stopgap. So it's like, how long we gonna keep kicking this can down the road? So if we go up, that means he gonna keep cutting off the fat, basically. But then again, it's gonna a lot of people gonna be jobless and things of that nature. But if we go down, which most likely, you know, how things are gonna go. And it's not that it's going down just to like the crash, but it's a correction. It's a deep correction because it's like, dog, this is what's happening. So, and you see it with the housing market, you see with the car dealerships, you see everything, everybody just cutting back. Like, man, we just closing our doors. And basically, they call it a recession. I don't want to use that word because I don't want nobody to thinking, man, the world is in it. No, it's just what it is. You know what I'm saying? If you know what I'm saying, you can judge recession by charts, but that surplus is what's keeping this. That's what's making this motherfucking this range right here.
Okay.
But boy, we go up, boy. You're
Yeah.
gonna see some motherfucking
It's
universities and everything just start. They're gonna cut.
it's a lot of liquidity up here, bro. If we go up, man. Look, if price breaks, and I won't be surprised, bro. I won't. I honestly won't be surprised if price somehow pushes beyond this point. I wouldn't even be surprised, bro. But like I said before, I also wouldn't be surprised if price made a nice push just to come back down into here and then break down from there. I wouldn't be surprised because the market is full of trickery, especially as people become more knowledgeable of how the market works. Like the level of patience that I have now and the level of knowledge I have now, I couldn't be tricked by the market. But due to the fact that I know that moves that I'm waiting on take time, is forcing me to be more patient as well, which is what I don't want to do, but it's forcing me to be that way. But luckily, we got Jeanius to kind of help out with a good bit of that waiting and kind of cheating in between. Yeah, it is a cheat code. To cheat in between to play those levels or even just key areas where we don't know what to do. You know, we still have the system to kind of help us know what's going on outside of what we can see with our own eyes. And so, yeah, like I say, I think we just need to see how this month closes. That's the biggest thing. I want to see how this month closes down first, and then go from there. Yeah, I want to see how the month closes down first, and then just go from there. And then we'll see how it goes. Yeah.
Yeah. Yeah.
Yeah, man. Shoot, I guess we're done for now. If you want to get back on later on tonight, you're probably gonna be asleep by the time I get back in.
Probably.
But got tomorrow anyway, so to prepare for next week. So outside of that weekly chart we're looking at, we can also get down into some levels on SPY that we could possibly trade going into next week, because out of this low here and this low and this low here, that's a lot of liquidity swept. Just sweeping these three lows right here, that's a lot of liquidity swept just off of these four candles here. 4 candles swept liquidity from these lows right here. So the odds of it pushing up from here are higher, especially if you're looking at, you know, if you like to pay attention to like RSI and stuff like that in terms of being oversold. You know, you can look at where the RSI is pretty much oversold and it's down at the oversold level. And if you want to, you know, I guess I won't say assume because it's not assumption. If you want to look at something like, I can't even draw it, but this little slight divergence here where the RSI is starting to turn upward, and from this divergence here, this was the last candle that was put in from this low, and from the last candle now, the last candle's low is here. So this was a good drop from this point while the RSI is pushing up. So this could be reversal confirmation, at least for that pullback that I talked about, to create that lower high. So this could be the beginning of a lower high, especially after it having to break structure from this point right here. So technically the trend is still, technically right now, the trend is down. So if we do get a push up here, we could get a push back up into this last support area before it broke structure, which would make it a break and retest, which would, you know, create that lower high. So yeah, meaning that basically we should look at the market to push up, going over the next couple of days. Yeah, we'll do that. So I'm looking for sales, but if we do get another sale day below here, if somehow we get a sale, start getting sales below here, and it just continues down, brother, we might be looking at our first capitulation of the year, and that would be, bro, that would actually be scary. I hope that we push up. That means that the market still has some type of like bargaining within it. But if we capitulate, that means that the big guys have also given up on buying, and we just gonna just die off in this market. So hopefully, yeah, hopefully that's not the case. I would want us to push up and, you know, kind of keep finding our way until we get that breakdown like we want. But yeah, all right, brother, I'm gonna close it down right there because it's 9:03. I gotta be getting out of here.
All right, bro.